Perfect. So, um, today we're talking about investing in individual stocks versus investing in ETFs. And before we get into individual preferences and how me and Moise both, kind of form our portfolio, is it with individual stocks or ETFs? It's good to kind of get an overview. A lot of us know about stocks, so I won't spend a lot of time, kind of explaining what a stock is. But ETFs, I feel the concept itself is less understood, even amongst experienced investors. ETFs is a concept that's not understood to its full potential. So when we think about ETFs, oftentimes we think about stocks. So it could be a stock ETF, like an S&P 500 ETF. What is an ETF? An ETF is any investment fund that can be traded on the exchange traded funds. So you can buy and sell on the exchange, but it need not be a bag of stocks. It could be a bag of commodities. It could be a bag of stocks that trade in commodities. It could be a bag of REIT investments. It could be currencies. It could be um, metals, for example. Like it could be any kind of commodity or kind of instrument that you can think of. There would be an ETF for it. So ultimately, like you need to know what an ETF is to understand how to use an ETF. Now, coming back to the question, is it better to invest in an individual stock or an ETF? I think of it like a question that has various levels to it. You can't have one correct answer for for all. It actually depends as per my opinion, it depends on three main factors. The first is, what are you actually looking for? Are you looking for growth? Are you looking for diversification? That's very important because if you're looking for growth, oftentimes you can see that you can get better returns, more concentrated returns, higher returns in terms of dollar value returns if you are invested in individual stocks. So, for example, like Tesla would outperform S&P 500 in 2024, or Nvidia would you know outperform S&P 500 by leaps and bounds in 2024. But if you're looking for diversification, investing in just an Nvidia would not give you enough diversification. If you're someone that is looking for stability, then and therefore looking for diversification, I think ETFs is the way to go forward. The second factor is risk tolerance. So you need to understand what your risk tolerance levels are. If you're willing to accept on more risk for higher returns, then stocks is the way to go. But if your risk tolerance is low and you want to go with like stable investments, I feel that ETFs should be a no-brainer. And the last is time horizon. And again, here I feel like if you're in it for the long run, and by long run I mean 30 plus years where you're invested, you want to kind of invest an amount and then forget about it, ETFs would be the way to go forward. But again, as I said, there's not a lot of people that understand the true benefits of diversification. So oftentimes we see that if you open up TikTok or Instagram or YouTube, there is a certain stigma associated with investing in individual stocks, wherein people, if they say, "Oh, I'm invested in Meta or I'm invested in Nvidia," people think of you as, "Oh, you're invested in too risky assets. Just why don't you just invest in an S&P 500 ETF?" And every single video that any kind of finfluencer has posted on this topic would say, "Oh, just invest all of your money in an S&P 500, a low cost ETF, and you'd be fine with it." And I've kind of find that a really kind of a pessimistic view of looking at things. And if there is higher returns to be earned, um, why don't we invest in stocks? Why are we limiting ourselves just to ETFs? Obviously, there's a lot of other factors like we talked about, like risk tolerance and time horizon and all of that. Um, but just this view of, oh, investing in individual stocks is always the worst. does not sit right with me. I don't know what your views are on it, but every single reel that I kind of looked upon on YouTube, on Instagram, while researching for this topic, has influencers saying, you're better off with an ETF.
Yeah, I agree with you. I think, James, I think there's a lot of context that needs to be included within how aspiring investors and those that are looking to invest into the markets, how they make informed decisions. It's not as clear cut as buying one thing or the other.
Yeah.
In my experience, what's helped me and guided me in making investment decisions, whether I'm choosing between an ETF, that's a basket of stocks or real estate type of products, or if it's an index ETF like SPY, which is the S&P 500, or if it's like the NASDAQ index ETF, which is the QQQ, or if it's like gold or even water. Any instrument that I'm touching these days, I particularly look at a couple different aspects when I'm making a decision. And these two steps are really crucial. And to just get right into it, it's basically that I need to first have some form of understanding as to what the product is, right? Like you don't want to blindly buy anything. So let's say in the case of something unconventional, which I don't know if many investors are thinking about, which is water as a resource or a commodity.
Yeah, that's why I was smiling. I didn't know there was an ETF for water.
What do you know about it, actually? I'm curious to know, actually, before I dive into it.
No, I don't know. I haven't heard of an ETF for water. I was researching on other commodities. So I came across chocolate. So cocoa was the best performing commodity of 2024. And surprisingly, there's no ETF for cocoa. Cocoa like as a commodity.
Like the beans, yeah. Ones that make the chocolate out of?
That make, chocolate. So so I knew that, I mean, there's weird kind of ETFs out there. Water would probably be a real weird one.
Right. So I just to give a little story before I dive into those two parts that I was really talking about. So I think it was the Big Short. That was the movie. Mm-hmm. Great movie, funny, informative. At the time, believe it or not, when it came out, I had no idea what the Big Short even meant. Yeah. I was fairly unaware of what the financial markets were. I'm fairly, I would say, compared to like most hedge fund investors or avid investors and traders over like 30 plus years, like I'm way new into this, but I've learned and accumulated as much as I can over the last 5+ years because I believe that there's a lot of control you gain over your finances with being able to make informed decisions. But it was the Big Short, and it was the investor who predicted the financial crisis. I don't remember his name.
Yeah, I don't remember his name. So forgetting.
At the end of the video, I don't know if you remember, James, but it mentioned that his next go-to would be the water market, the market for water. And I was like, okay, so how do you invest into water? So now, fast forward today, there are ETFs, like you mentioned, for almost anything. It could be ETFs. I don't know if exists actually, but there's ETFs for water, for gold, for real estate investments. If you don't want to buy a big house, you can buy a real estate investment trust, a REIT, which has interests in a real estate property, and you basically become a shareholder. But so the water ETF was interesting because I was thinking to myself, okay, and this is me just having a little bit more of a creative sort of future focus sort of look, like, water, I don't believe the same thing anymore, but at the time I was thinking water is going to run out. And companies like Nestle are making a killing on water, right? Like you have tap water. In most places is just as good if you're living in a first world country, second world country. And then you go down the street and you're paying $3 for water, which is like absurd.
Yeah.
Is water going to run out? Then I looked into like the desalination process, like, reverse osmosis was an interesting topic. Should I install one into my sink? I'm not a plumber, so I didn't do it. But long story short, I'm thinking, water's going to run out. We should look into water. It might be the next big play. It's not, right? But because there's so much water out there, it's just expensive to clean up the water, turn it from salt water to drinkable water. But there's so much water out there. And I'm sure that this process will become more cost efficient. So you can go into the stock market and you can look up a ticker called FIW, if I'm not mistaken. Yeah, FIW. So it's the first trust water ETF. So I was thinking, okay, buy this. But I want to highlight something before I even show the chart is I had some understanding that, okay, this is money that's been invested into water, and I'm going to be a shareholder of whatever money they're looking to invest themselves, whoever's managing this ETF. ETFs, by the way, are also, in my opinion, have benefited me from saving on fees. So typically when you're having a registered retirement account, whether it's from your company that you are working for or whether you're doing it by yourself, you might be restricted on specific products. There's companies out there like, Manulife, et cetera. And in Canada, there's like Sun Life and et cetera. So they have their own basket of products that they're selling to you, and the company that you work for is giving you these choices to choose from. The problem with that I found was, for me, they were taking a small fee up to 3%, and over a long period of time, like 30 plus years, that can be a significant amount of profits.
Obviously, yeah.
So I saw ETFs as also an opportunity to put my money into a product that probably grows, if not the same or better. I can track it. I can reinvest my dividends, etc. But the fees would be significantly low. One of the reasons why I really like Vanguard. And so with FIW, it's I understood the product. That's the first thing. The second two pieces are super important. I always invest in things that I believe in the long run either are showcasing an upward trend, right? Like on a candlestick chart or a line chart, it looks like it's going up. So the 45-degree angle towards the top right of your screen. It's not going down, right? I'm not really interested in buying things where I feel like I have insider information or something special, or I had a dream that, oh, this is the thing. I'm looking for things that are trending upward to some extent. So I understand the product, it's trending upward. The third thing is the most important, because you want to be able to find an entry. You have to find it in terms of an entry that aligns with your goals, whether it's short-term or long-term. You want to find out, if I buy it, the entry price that I pay for it is going to play a big part of the narrative on how I will handle the swings and how in the long run my upside potential is. And I think those two things have helped me personally so much. So if I can share my screen right now, I want to show you the next greatest investment. No, absolutely not. It's just a consistently growing investment. This is FIW. And I have the monthly chart here. And so again, the first principle was, okay, do I know what this is? And it's basically an ETF based on water, okay? And the second concept, or actually the first step of putting money into it is it growing, right? Like you can go into a quarterly chart, you can go to the yearly chart. It's trending up, right? It's not rocket science when it comes to that. And once I decided, okay, it's trending up, I got to find a way to get into this stock. So typically you see areas like COVID right here in 2020. You see this area here when I think interest rates were really high and the market was going through a short-term bear market. So an ETF like FIW is behaving kind of like the S&P 500. It's kind of behaving and going in alignment with the S&P 500. So the second part is really just finding an entry. And you find an entry based on two more important things that I firstly use myself. If I know it's on an uptrend and I know that I want to find an entry, I don't want to overpay. So areas right around $95, $93, like it was too expensive because it already went up such a significant amount. So you have to wait always for some form of pullback. And this is where the moving averages become really helpful. This is where you can sort of see, okay, look, I'm willing to pay $60 a share for this. I'm willing to pay $70 a share. I'm okay with it correcting $10. And since then, the upside move has been there, right? Now it's correcting a little bit more. Maybe if you look in add, I would add here. But overall, it's like, in my experience, whether it's an ETF or individual stocks, I do believe ETFs are more diversified because they have different instruments or different types of products. I think FIW has investments and interest into different type of water related instruments themselves. So it's more diversified, which means it's less risk, because if one of them goes under, FIW is not going to go to zero, right? But a stock like SMCI just came top of my head. Like this thing, like I'm not touching this because it's just going down, right? If the chart was like this, maybe. But it's just heading down. And this could be in the future interesting, because I see a lot of folks mentioning this. I've had some, family friends ask me as well, and I'm really just not interested because it's just trending down. And if you go here back to FIW, there's a huge difference between what we see in these two charts. Now, SMCI is just one company or one stock or one holding company. FIW could be a variety of different companies with different interests and different like your $102 per share is going to be going towards multiple different instruments. So you're diversifying. So it's lower risk. But in a nutshell, I still think that if you can find and identify areas where you can find an entry on an upward trending stock like S&P 500, it's been uptrending. I have been saying this for myself. Like, this is the same thing that I'm noticing. We saw the chart for FIW. It was similarly going like this for quite a significant amount of time. You could say between this point and between this point is about the same distance. I would not be surprised if another pullback happens on the S&P 500. And because the S&P 500 is just trending up and it's diversified because it's an ETF that's based on an index, it's 500 of the best stocks in the stock market, buying a pullback is less risk because you know overall it's going to probably go higher because you're using the past price action or the past movement of this stock to determine what the future would hold. I would be very surprised if it goes under $235. I mean, it could. There's no way that it forever can't, or it's not impossible. But this is how I would decide. Like, from my point of view, in a nutshell, whether it's an ETF or stock, yes, stocks are just one instrument. ETFs are diversified. Great. But even if I'm looking at individual stocks or an ETF, one or the other will not be rated based on the fact that they're entirely diversified or just a single entity. But I always also look at a line chart. I would look at a candlestick chart. Like, a lot of folks, they use line charts, right? Just look and see, is it going up, right? Go on a higher time frame, zoom out a little bit. Is it going up? If it's going up for a long period of time, you know what you're investing in. And I like the area where it's pulling back to, then I would not be shy to make a purchase. And this is something that I apply every single day. And I hope that kind of answers my part of what you've been asking, James.
But would you say, like, because I view ETFs as I'm a huge fan of thematic ETFs. So if I believe in like a particular theme or a particular sector, I would use ETFs to kind of get the benefits of being diversified across that sector. If I would have done that, as opposed to, let's say, investing in Nvidia versus investing in AI and in an AI ETF, maybe investing in Nvidia would have given me higher returns in 2024. But I would have been fine being invested in the ETF just because I believe in AI as a theme or as a sector. I did the same with, so in my portfolio, I have an ETF that tracks the top 50 companies in India because I believe in the India story. So I believe that India would do well in the coming 10 years or so. So I want to be a part of it. So rather than me being invested in individual companies in India that I know will do well, why not just buy a bag of particular stocks that particular fund managers think will do well as well? So in a way, and it's also easier for me to invest in an India ETF as compared to investing in international equities through, other stockbrokers and fees and commissions involved and all of that. So I'm a huge fan of thematic ETFs, sector ETFs. But when it comes to an S&P 500, and it's good that you showed us the charts, how much of that uptick is driven by the top 10 companies, right? Because S&P 500 is a top heavy kind of an index, I think around 30-35% of it is dominated by the top 7 companies, the max 7. So are you really getting the benefit of being invested in SPY or a VIU or a QQQ for that matter? Like, how is that index diversified if it is not equal weighted? Obviously, it's not equal weighted. Nvidia, if it goes up 4%, S&P 500 does well. If it goes down 10%, it dips, even though the remaining 493 odd stocks are doing well. So just to kind of show you what I was mentioning, give me one second. Yeah. So this is 2023, a bit outdated, but it'll be nice to kind of see an updated figure for 2024. So it's the return for S&P 500, but S&P 500 divided into two groups. So the Max 7, that's the green line here, and the rest of the 493 stocks. S&P 500 did, I think, 54% in 2023, whereas the S&P 493 is basically flat at 5%. And if we look at the split, around 35% of S&P 500 is the Max 7. And even if you go back to 2020, around 27% is Max 7. If we go back to 2015, 10% of it is Max 7. Still, 2014 is a long time back. So it's like 10 years ago, 10% of what you thought was diversified is into 7 stocks. Not exactly diversification that you actually want to achieve. And out of those 7 stocks, so Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla, I would say all of them are tech stocks. So is it diversification? I would not say, I would not be 100% confident of saying that I would have fully diversified if I would have invested in an S&P 500 ETF. Maybe an S&P 50 or an S&P 100 ETF. Sure, it gives me the benefit of being diversified across sectors, while also being invested in top companies. But for example, would you even know what the 300th company in the S&P 500 is? Or would you know what 75% of S&P 500 is made up of? Most of these companies do not last the next 10 years. That's statistically proven. So, are we diversified enough? Do you think investing in an S&P 500 ETF is the way to go forward? Like, that's the reason why I feel like betting on thematic ETFs or sector specific ETFs works out better in the long run. It's also like I was reading up on it, and I found a really good analogy on on ETFs versus stocks. So investing in stocks is like having your own garden, and investing in an ETF is like having your own forest. So when you have your own garden, you're like so invested in each and every plant. You're like, watering them daily, giving them nutrients like manure, all of that kind of stuff. You're so invested in it. So it's the same level of interest and resources and effort that you put into while investing in individual stocks. So you need to know more about the companies. But investing in having your own forest, you don't need to water the trees every day. You don't need to take care of it as much as you would take care of your own garden. It still grows. At the end of the day, you would still be happy with having a garden and still be happy with having a forest. But personally, I would feel a lot more happier if I have my own garden. The reward that I have, that I kind of get because I have my own garden, I've put in that effort, means a lot more to me than having my own forest. But that's just an analogy. But I feel like investing in an S&P 500 ETF does not, in this time and age, does not lead to the levels of diversification that it would have done maybe 10 years ago. Right now, with the crazy rise in AI and tech stocks, I don't see the S&P 500 ETF as as the best instrument for diversification.
Yeah, it's a good point. I think that it's important that you made a good point that sector ETFs might be more competitive when it comes to risk diversification, right? And at the same time, like I was just thinking, if the S&P 500 is like 35%, majority of those 7 stocks, I believe the same story is for the NASDAQ 100. Mm-hmm. So the QQQ index ETF, I believe 30% include Apple, Amazon, Google, Facebook, Nvidia, right? And then I believe they have a lot of the weight, about 30% of the weight. So there's also other options that when you're looking at ETFs, you want to know what they're actually tracking. So VT, for example, I was looking up, has about 4,785 holdings. And according to the profile for the VT Vanguard ETF, it's tracking the performance of the FTSE Global All Cap Index. So then you have to also, and I don't know what the weight of distribution is, like how much of the 4,700 are just small percentages versus like 10 of them being a major part of it. But I wouldn't be surprised if it has the same sort of narrative that 20 to 30% are the major stocks you see on the Mag 7 as well. But I understand. Is there a way that you would address how to make a decision when it comes to industry or sector-based ETFs? Like, do you know what you need to look out for or what you are looking out for when you're making that decision?
I mean, if you invest in an S&P 500 ETF, you're well diversified. I'm not saying that diversification would be a problem if you invest in an S&P 500, but the reason why people invest in an S&P 500, I feel most of them, is because they feel that, oh, I can take advantage of the top 500 companies in the US, for example, right? I have a particular problem with people investing in stuff that they don't know much about. So, for example, a very big reason of why I didn't invest in NVIDIA or like AMD or like semiconductors in general was because I didn't understand the model. Like I didn't understand what they're actually investing in. If I put my money in an S&P 500 ETF, which I have, just to disclose as a disclosure, I have some money in an S&P 500 ETF. I would know maybe the top 100 companies. I would have no idea, what the 101st company does or what their operations are all about. So, in a nutshell, I'm just investing. If I'm investing $100, assuming that it's an equal weighted, or $500, assuming it's an equal weighted ETF, I'm investing 400 of those dollars in companies that I have no idea about. Just blindly trusting that, okay, because it's in an because it's in an index, it'll do well. And because I showed you the charts, it's quite evident that that's not the case. 493 companies, if we just invested in those 493 companies, it would have been a flat 5% return, whereas the S&P 500, all in all, gave a 55% return. My approach is quite simple. And it all depends on, are you willing to put in the effort to know a bit more about Google, for example, or do you want to know a bit more about Amazon as an individual stock as compared to as just being a part of the ETF? So if you have the time and resources at your disposal, I would always say go for individual stocks. My approach is quite simple. I have a major portion of my portfolio in individual stocks, but I keep adding thematic ETFs to take advantage of sectors that I believe will perform well the coming few quarters or few years from now. So, like I said, because I believe in the India story and because I believe that India would do well, I am comfortable investing in an ETF that gives me the flexibility of being invested in a particular geographical region while not being so invested in, what happens in India tomorrow or what happens in the Indian equity markets 3 months down the line. I don't need to worry about it. I know that I have the time and resources to kind of evaluate stocks, the individual stocks that I'm invested in. So I can track NVIDIA. I can, kind of know what's happening with NVIDIA. But I don't have the time and resources to go back and check what's happening in India. So I would use an ETF to reap the benefits of it. Same way as last year, while I was not invested in NVIDIA, I knew that the semiconductor industry and the AI trend overall would do really well. And therefore, I was invested in a semiconductor ETF. So that gave me the flexibility of, and the peace, to be very honest. I slept with peace knowing that while I don't know much about what an AI chip is, my portfolio will still reap the benefits of it. So that's the approach I take. I have a very small portion of my portfolio in an S&P 500 ETF, just as a tracker, but it's not a lot, and I believe in investors who have the time and effort, who are willing to put in the time and effort to know a bit more about those individual companies you're interested in, stand a large chance of getting higher returns. The possibility of higher returns far outweighs the costs involved and all of that. Because even for cost, I would say like investing with Wealthsimple or Moomoo, for example, like they provide commission fee free investing. So me buying Apple today, even 1,000 shares, is comes at no cost to me. Whereas with an ETF, I know there is an expense ratio. So if I'm invested in an ETF on Wealthsimple, I still know there's some returns that they would hold back as fees. But if I invest in an Apple stock, I know they're not withholding anything from me, and because I'm not paying anything out as commissions to Wealthsimple, it's essentially free investing. So that's another major decision factor. But overall, I feel like for me, investing in individual stocks plus a healthy mix of thematic ETFs here and there, works best for me. What's been your approach, though?
No, I think that's great. That's really insightful. For me, it's simple. I mean, because I'm more technically driven, my number one goal is to keep as much of the gain, the compounded rate of return or the compound interest. So with an ETF or a stock, I would attain that. With most brokers, like you mentioned, it's almost like $0 commission. Basically, there should be no reason why you're paying $7 to $10 per trade to make an investment. I think that model eventually should be evaluated for the traditional big brick and mortar banks. Like in Canada, some of them charge a lot of fees. But there's so many different ways, like with interactive brokers, where you have very, very low fees, if anything. And I believe that I would like to see how I can approach the sector-based plays. But right now, it's just about uptrend, understanding what I'm putting money in, and finding a good entry where I'm getting some form of discount, and letting my investments stay there for as long as I need it to. Majority of it is going to be in the S&P 500, simply because for missing out on the opportunity costs of 3 to 4%, I'll have the 5 to 9% consistent growth over a long period of time. I don't have to just to worry about it, and I'll just keep adding once the market presents a new opportunity. And then in addition to that, look at the crazy like water ETFs or NVIDIA when it's starting to look really good on a technical chart. Tesla, I actually had a huge opportunity cost with Tesla. I think right before, like, it was hanging below the 200 moving average for a significant period of time. I think about a week and a half. But I was thinking to myself, okay, I've been waiting for this buying opportunity on Tesla. Sent myself an email saying, buy Tesla. I didn't pull the trigger on it, and it went from 150 or something all the way to 400 plus. And I was like, okay, missed opportunity, but it was a good play. So those things would be like position-based plays. But overall, it's just mixing as much of the technical analysis. I would love to learn more about the fundamental part, and that's why I think that having these episodes gives me an opportunity to learn as well. But the technical side is purely what I'm focused on, understanding what I'm putting my money in, trying to get as much diversification as I can, but also making sure that I have important stocks that are making moves as part of my portfolio. And that's worked for me, I think, across the board in the last few years. If I can beat the market, I'm happy with that. That's basically my principle. If I can beat the 9 to 10% that you would get typically, I'm okay with that. Even attaining 20 to 25%. I've even considered, when the market is presenting me an opportunity and I've gained 20, 25, 30%, and I'm expecting some form of pullback, how should I deal with that? Do I need to hold all of my holdings, or can I play positions? So I'm trying to learn a little bit about how to do that. It requires a lot more critical thinking and involvement in the market, so it might not work for me if it's a long-term investment. And of course, the day-to-day trading, that's just easy because I'm not holding my position. It's less stress because I'm in and out within an hour or 3 hours or so. But for anyone that's looking to invest, just know what you're putting your money in, as James, you mentioned. Understand what the narrative is, what your expectations might be. Be prepared for any sort of wiggle room. Diversify when you can. And don't be shy to invest into stocks, sectors, and ETFs. I think there's a lot of opportunity out there, and we're very much empowered with all these tools and technologies and platforms, and just making an informed decision would be the best advice that I would give, that I apply to myself.
I mean, I have a quick question for you. Like, I know we can trade stocks on a technical basis, like look at the candlesticks and stuff. Does it work the same way for ETFs? Like, if I want to trade, I don't know, the water ETF, would I rely heavily on the technicals, or should I keep track of the underlying assets as well and see where they're going?
Yeah. So the first thing is, absolutely, technical analysis works on any time frame, whether it's the 1 second time frame or the 1 minute time frame or the daily or the weekly chart. It works for any instrument on the market, whether it's stocks, ETFs, commodities, futures, forex, crypto, almost anything, as long as you can get it on a candlestick chart, because candlestick charts are basically telling you human behavior, buying and selling, fear and greed, right? So if you can get it on a chart, you can absolutely make a decision. Now, how far you take that, and if you complement that with knowing what's within the holdings, what's happening within the company, if it adds value to your technical analysis, by all means, see if it works. And if it's working, keep on improving. For me, it would require me extra work, and I'm not going to commit the time unless I do it well. So for me, it's more like, if Tesla is hanging below the 200 moving average, but Tesla is the best-selling car, electric vehicle, has the best crossover, or the what do they call these? These like SUV sort of things, like with the Model Y. If Elon Musk is best friends with Trump, he's going to have the best policies. He's now this Department of Government Efficiency, all this hype around him, and he's the primary shareholder of Tesla, and they're innovating, and it's really discounted. I'll buy Tesla. That's my fundamental analysis. Yeah.
That's a no-brainer then. Yeah, I mean, I read this quote once, and I think it's a good point to end this topic, or kind of open it up in the comment section for further debate. But concentration builds wealth, while diversification keeps wealth. So it was quite it's a simple quote, but if you think about it, it's actually quite deep. So yeah, I mean, I feel people need to understand what they're investing in. That should be the prime factor that drives their investing decisions. Personally, for me, as I said, I'm not comfortable investing in 400 odd companies that I don't know much about. But if you're fine with the returns that investing in an ETF gives you, then there's no harm in it. Obviously, there are people that would push the agenda that ETFs are hands down the better option. I don't feel so, but yeah, that's my take on it.
That's a really good quote, by the way.
Yeah, that's a really good quote. Yeah, concentration builds wealth, diversification keeps it. Thank you for tuning in on another episode of Epic Market Podcast. This is James Invest,
and this is Babar Trades World. If you found value in this episode, please make sure to subscribe.